So what are the performance indicators that drive your organization? Most likely you have a service organization and you primarily sell. You are responsible, probably, I'm guessing, if you're listening to this, you are the big gun salesperson. Maybe you have other people that have cloned you by this point. You have mini-me's, people that sell certain parts that you've delegated off. Nevertheless, what you can do now to develop your enterprise and move from operator to business owner is start thinking about 5 critical success factors, or 7, that you need to measure on an ongoing basis. And these can be daily, these can be weekly, right? These can be monthly. But I'd like to, in this audio, stay focused more on the daily and the weekly indicators. What you don't want to be doing is digging through a pile of rubble trying to find the numbers in your organization. Now, what I'm not talking about yet are the numbers, the score that you keep from your pro forma statements, your balance sheet, income statement, and your statement of cash flows. So I'm going to talk about that later. What I'm talking about now are what are called critical numbers and what are called smart numbers to drive the day-to-day executive decisions of your organization. Critical numbers are the numbers in present time. They're the numbers that show your exact position now. For example, cash on hand would be a critical number. How much money do I have in the checking account that checks can be written on today, looking at the accounts payable that's about to go out, right? A smart number would be a number that forecasts where you'll be at a certain destination or time frame. So a smart number would be probably forecasting how many prospects are in your pipeline that are graded in such a way that the money is due in the next 90 days. Or maybe receivables, if you're invoicing your customers and you're on a net 30 or a net 60, net 15, maybe your receivables, you can tell the tale there of how much cash will come in on a certain date and time. What I would suggest is that you pick 3 critical numbers and you pick 3 smart numbers. Or, depending on the size of your organization, you do this for every department or unit. And then, of course, it trickles down into the individual positions that that unit occupies, right? So maybe one of those or 2 of those are directly connected to the activities that those individuals or team members occupy. So start to think about if you were to get a flash report, a report that you could, without needing a lot of research, without going into the science of it, if you could look at it in a flash, 5 minutes, get the pulse of your organization, what would it consist of? So some of the ones that I've seen, depending on various businesses, for example, I have a restaurant client that looks at the average transaction size on a daily basis. How much was the average ticket compared to goal? You could do month-to-dates, you could do year-to-date cumulatives on this. MTDs, YTDs, those can be helpful indicators. The number of customers, that could be it. How many customers came in today? Let's say you're an insurance agency, right? What might be some of those numbers? Well, how much cash on hand do I have to write checks out with? How many new files or new customers came in? How many new insureds did we convert today? Right, something like that. How many referrals came into our organization from existing business? How many cross-sells were in our current acquisitions today, right? How much cross-selling are we doing? How many add-ons to existing policies, things of that nature. So by looking at your goals, it should indicate to you, by looking at what's important to your organization, especially in marketing, if you're looking to increase your customer base, if you're looking to increase the transaction size, or maybe you're looking to increase the lifetime value of a customer, these can be goals that tell the content of what your flash reports could be, because you want to know what your true distance is from where you are. You want to be looking at your numbers from where you are to know what you need to do to make adjustments. You may be swinging off course and you want to eliminate small problems before they become big problems, you see. And so the idea is that you are designing what this is. Now, you may want to get together with a couple of your department heads or partners and talk about their own roles and what indicators they most influence. And then talk about what the source of those indicators are going to be. Where do they have to go to get that information? Where do they have to go to find customer service or customer relationship data? Maybe it's the number of complaints that you're getting on a weekly basis. Okay? Or maybe it's something that you critically measure. For example, in our coaching enterprise, it's how many coaching calls that we actually conduct in a week. It's how many minutes we actually are accumulating on the phone. We should be averaging 6,000 minutes a month. So if we're at 4,000 minutes a month, we know that we are way under capacity. So what's going on? We're going to want to talk to our marketing department, or we're going to want to get some more referrals. We're going to want to bring it up to 6,000. Or what could we do to go to 7,000 minutes a month? So those are critical indicators that we would want to look at cumulatively on a daily basis. And that way, I'm on the pulse. I'm on something that I can make executive decisions by on a moment's notice before a small problem becomes or escalates to a big problem. Now, smart numbers could be based on your sales manager, right? It could be outlook focused on what's the forecast. About 60% of the sales manager's activities are forecasting activities on where we're going to be. So that would assume that a pipeline is being graded by each salesperson. There would be probabilities, closing ratios, depending on how many steps are in the sales process. You can gather that data by making a simple study of your past conversions. You could take 10 or 20 of them and look at the time frame involved, what were the sales cycles, things of that nature. And so that would indicate where you need to prime the pump, where you need to put a little bit more pressure on the sales activities. It could be the average transaction sizes, of course. It could have something to do with how well you qualify your customers. It could have to do with how well the sales skills are in the salesmanship in that process. So these numbers are there to guide you in making executive decisions day to day. So I suggest getting together with your department heads, especially the accounting department, and looking at the key indicators that you want to be looking at. You may want some ARs on a weekly basis, maybe APs, accounts payable. Maybe you want to be controlling inventory if you're a products-based business. You want to know what your inventory turnover rates, how much you've got on the shelf, things of that nature that you need to be able to pull, know, be able to make decisions on. And you can run comparison data. You could take swaths of time as to where you were last year compared to this year based on this. But again, know your numbers. It doesn't have to be rocket science. You don't need to be a CFO to do this. You have enough intelligence. It's just knowing what your goals are and then looking at current reality. You should be able to ask yourself, well, okay, where do I find this data? What's the source of it? And what's the frequency? Do I look daily? Do I look weekly? How am I going to package the report? How often does it get to me? Does it come Monday morning at 9 o'clock, or do I get it Friday afternoon in the final of the week so that I can see how the week went? What am I getting on a daily basis? For example, I have a client that wants to know on a weekly basis where the credit card balances are. So he knows how much to charge on them if he needs to buy products. He's an IT company. So he wants to see how much the company can borrow on their own credit cards against the accounts receivable that they're owed to pay down those debts. So it's a constant balancing act with the controller and the organization of how much company debt we're taking on to furnish the technologies for the customers and when their invoices are likely to come in, so we can keep those balances in check and maintain the space on those cards and so forth. So it's really up to every organization as to what you prefer. I'm just giving you some parameters, kind of a framework, a concept to work from, and then meet me halfway. Now, how do you know how productive or how efficient or how effective your organization is? What is your scoreboard? Do you know how to read your balance sheet? Do you know what the purpose of it is? When you look at a balance sheet over 6 months, and you're kind of checking out the equity levels of the business, what it's worth. Okay, that's something to look at. You have 4 types of money that you need to be looking at in your business. You have equity, revenue, profit, and cash. That's equity. So what's your company worth? You have revenue. What's it bringing in? You have profit, in other words, minus cost, variable cost, fluctuating cost, and fixed cost, continuous cost, in other words, the predictable cost, minus that administrative cost or burden rate or overhead, what's the margin? That would be profit margin. And then you have your cash flow, which would be profit, and it's minus operating cash flow. Now, operating cash flow, OCF, is what you spend the company's money with. You do not make company spending decisions on profit. Let's get that straight. So the purpose of a balance sheet is to show the equitable position of the business. What's its asset value versus its liabilities? So what you really are looking for here in looking at the productivity of your company is how much operating cash flow you're able to turn off the assets that you have. Now, your assets, probably your number one asset that you're looking to turn into sales is your employee. You know, you don't want to be increasing the cost of your assets to increase sales. If you're going to increase it a little bit, great, but not having to increase it massively to increase sales. And that shows that you are being effective at utilizing the assets that you have. And these are the hiring activities of your business, making sure that the people are fit and equipped to do the work, that they are actual assets that are producing sales. So the first indicator would be to take the total assets for whatever the period would be on your balance sheet, and you want to divide that by the amount of sales that you get from those assets, right? You want to see how many sales are being produced out of those assets, and are those assets furnishing sales? And you can compare that to the previous month, the previous quarter, the previous year. You decide the bracket of time. The next one is how much profit that you're making out of the sale, and you could take that over a year or a month or a week, however swath of time you want, but you're going to be getting that item off your income statement, so you can talk to your accountant or controller, bookkeeper on what that is for the swath of time that you want. Now, I suggest that you take a 6-month look at this, that you chart for 6 months, and that you look at trends over time. So you're coming off your income statement, you're asking for those two indicators, right? You're looking at what was our total sales and how much profit did we take out of those sales. So that would show you if you're efficient of how you're doing with how much load you're carrying, right? Are you actually profitable? Is it compared to the right profit levels for the industry? Is it compared to your profit goals? So how are you doing? Are you profitable? Are you efficient? Are you able to keep spending under control? One of the challenges that a lot of entrepreneurs have is they have the need for an impressive lifestyle. And they get a lot of pimp factor. They want to look good, so they start buying the best. And they got to have the best despite the fact that they don't need it. So I suggest taking an inventory, be very honest with yourself about what you need and what you really don't need. It's something that you want, but it's something that you really don't need. And so one of the biggest liabilities to a business, what really stifles profit, is the business owner is not spending correctly. And they are buying equipment, a copier, that they really don't need. They don't need that good a copier. So you might lower some of your ideals there. You know, the business owner is one of the most heavy burdens to the business. So now you come out with your profit out of your sales, but what's your operating cash flow out of your profit? Your operating cash flow comes off your cash flow statement at the end of the period, end of the month. It's how much cash you had at the beginning of the month and how much cash you have at the end. And so you're going to divide your operating cash flow into the amount of profit that you have, and you come up with a trend, right? You're taking your operating cash flow out of that profit. So you're looking for comparisons. You're looking to see if things are swinging up or things are swinging down. Your operating cash flow is going to be distributed in 3 ways. One is it's going to be distributed to you, the owner. Now, I recommend that you position a fixed salary and you pay yourself after you pay your business. So pay your business first. If you want to make a 10% profit, then take 10% out of every check that comes in. Put that in a holding account. That becomes working capital for the business, but don't touch it for 6 months. That's part of your assets, is that you have working capital. Okay? You've gotten money. You've retrieved money from what you have put out. And that way you have margin. You have financial margin to work with, and that way you can organically grow your business. What I hear often is, JD, my credit line is totally sacked out. I've just maxed it up. I don't have any organic growth money, and I'm in a very poor cash position. And you kind of, your own habits have inserted you into that. Assuming you got a good marketing model, assuming that you're selling, what's happening there is that your costs are too high, either because of pimp factor or you just don't have the right amount of control. You're not paying your business first. But when you pay your business first, just like you'd pay yourself first, you got to live on the remaining percentage. You got to budget within what that is. And when you do that, when you supply your business with a limit like that, the demand will stop there. It's when we don't have a supply, when we don't have any budgetary constraints, the demand will rise and push the limits of the supply. And when demand takes control, that's where we get overexerting our business. That means we have more demands on the capacity to fulfill it. And we strain it. We rob our business. And one of the ways we do that is the business owner takes too many distributions. Separate yourself from your business. You are not your profit. Your profit is owned by your business. You are a salaried person. You take a fixed amount every single week, every month, and you plan for that. If you need to increase sales to be able to afford that, great, but consider yourself as a fixed expense. Okay, now operating cash flow is also for paying down debt. So we distribute it that way. We also buy new assets. So we buy assets with cash flow, we pay distributions to the owner, and we buy debt. We buy down the debt. And so you're able to see over time how much operating cash flow you're getting out of the profit that you have. And ultimately, you could take the operating cash flow out of the assets that you have over time. So OCF over assets shows you your return on assets. And that should kind of pull it all together, showing you how effective you are by having great sales off your assets, how efficient you are by having profits out of those sales, and how productive you are by having operating cash flow out of profits. And you trend that over a 6-month period, and the reason you do this is that you're able to determine the indicators, the activities, and where or who in what roles occupy those activities, to pull those activities back up towards the numbers, to make adjustments, to be able to optimize those activities, get things under control so that you have the consistency, the reliability, you have the variations worked out. And that if you continuously operate that way, you're operating at a level that is optimum, you're able to be productive, efficient, and effective. And what that does is create a sustainable business model. It's not about size, it's not about speed. Let that go. Size is not best. I had a business that I was coaching that we started at $500,000, small business, $500,000. We went to $1.7 million as a construction business. They made far less money at $1.7 million than they did at $500,000. So it was not the best thing to do. We were able to do it, but it wasn't the best cash position for the business. So we brought it back a couple $100,000, and we found the exact spot where we could operate, and the business owner was able to maximize his quality of life, balance out a healthy revenue for the business, a healthy profit, an enjoyable type of work, a level at which the employees wanted to operate and stay without being strained. So we found a really great sustainable place. It's not about revenue. It's about cost and how much you can make off of your business, because your business is a cash flow machine. And the one asset above all else that you can control the most is, that's right, your earning power. And you do that by upping your talents, by upping your abilities, by increasing your skills. Because if I put you side by side, same market, same abilities, same business, same employees, I put you up to the test of another business owner, someone's going to win. Why? Because it's your habits. It's your behavior, your thinking, your enterprise thinking that drives your organization by comparison. That's who wins, that's who loses. It's about what's in your mind. It's about what's in your behavior. And so whoever's at the helm is going to win or lose. Now, where do you go with this? What would be a good next step? I would sit down and have a meeting with your accountant, bookkeeper, or controller and talk about these 3 key things. We're going to trend this over 6 months. Here are the ratios, right? And then go over those. And start looking into your balance sheet, your income statement, and your cash flow. Now, cash flow and balance sheets you can bracket over time. You could take a 6-month period, or you could go month to month. You might want to go back, and have those produced. You might want to do the last 6 months. Income statements are kind of a prediction. They're not a reality show. They just show what sales are counted on They may have been contracted, but the actual money hasn't come into our accounts. That's why we can't make decisions based on profit. We can make it on cash flow. That way it's more actual in the picture. But what the income statement does is it gives you a good projection. So if I've sold $30,000 in product, that doesn't mean I've collected on those invoices. That means I'm owed that, but I may have achieved those kind of sales. So again, I'm able to see what kind of profit I'm able to make off those sales as they come in. Now, on the operating cash flow, I've got to set up some controls. So set up your credit and collections policy. The person that goes to the bank should not be the person that does your accounting entry. You probably know that. You want to separate that, right? You don't want to have the same person that's toggling with your digital amounts and also going to the bank, because that could inspire embezzlement and unethical behavior. You want to have someone separate who's going to the bank making deposits and someone who's loading in your numbers. Make sure that that's clear. Set up credit and collections policies with your accounts, letting them know that you're not a bank. Set up your net expectations on when you expect to be paid, and attempt to get all those elements in your aging sheet, all the ARs that are owed to you underneath 30 days. You just have to put the right person on it and set up the processes, procedures, the policies to ensure that you've got good cash flow practices. There's two reasons why entrepreneurs get into trouble with money. One, and I may have said this before, but here it is again. One is that they go out into the marketplace and they do all the activities to get the money in. They focus on cash. And so they focus on receivables, they focus on doing all the things to get the jobs finished and get the money in, but they neglect all of the digging, the crop setting, the watering activities to furnish the future to become cash. And so they negate all the important farming activities that are coming up, and all they do is they hunt for the immediate things, or just the opposite. They get into a constraint because they hunt so much, they go out and farm so much, they go out and do all these things to bring in all the long-range opportunities, but they negate all the things that the business has to do to bring in the cash. And so it creates constraints, right? So the money isn't there to pay the short-term bills, debt, payroll. That becomes a constraint, a progress blocker, or just the opposite. There's money coming in, but there's a doldrum coming. There's a dead period. There's dead space coming because we haven't done all the legwork, all the footwork to kind of ensure that the future is going to become our sustenance. And so we get hills and valleys, what I call sawtooth profile cash flow, up and down like a sawtooth, right? So it looks like an episodic cash flow where we go through months of constraints and constriction, throwing things onto credit lines, trying to borrow money from friends, and it becomes a way of life. And that's not what you created your business for. You want to be planning right, doing the right things, making the right decisions, giving the right timing to things, to maintain an offense-driven position with your business. If you get into these kind of constraints, take responsibility. A lot of it has to do with your own cash flow habits. But by applying some of this thinking, by putting some controls in there, by understanding better what your balance sheet is, what your income statement is, and your cash flow statement, go take an accounting course. Go take a simple coaching course on accounting. Get together with your CPA. See if he has a liaison that he can send out and spend 2 or 3 hours with you on how to read through your income statement, cost of goods sold, gross profit, how profit's calculated, what does it look like after taxes. Go to your financial planner. Talk about tax planning, right, and how that's going to affect you. What kind of money is going to be taken out to go to the tax man? Can you still remain profitable and operate? What about your insurances to protect and preserve things? Make sure your workers are compensated properly. So you've got a lot of things to think about here in the fiscal dimension of your business. But the idea is to look at the real health indicators to know what you're doing here long term. You need to be financially literate, at least literate enough to be able to also look over your CFO. If you're going to be delegating what you do in finance, you want to get a read on how to know what's going on there. You don't want to be the blind leading the blind. You want to have just enough so you're equipped and you know how you're going to get a read on the dials. If you don't have a dashboard, you don't know how to program the computer, right? So get to work on this stuff. Okay, you may want to play this back. Do you remember what we talked about? In the first part, it was about more immediate critical success factors and a flash report. What are the indicators? Where do you draw them from? Who's responsible for giving them to you? Put 3 or 5, maximum 7 in a flash report. These are critical. They're on time. They're current snapshots. They could be month to dates, year to dates. These could also be smart indicators. They're forecasts coming out of sales or marketing that show you where you're expecting to be positioned. The second part was the CFO scoreboard. How do we create a sustainable business? It's not about size. It's not about speed. It's about sustainability. It's about maximizing your assets, It's about watching month to month, trending, how your profits are coming out of your sales, about how your operating cash flow is coming out of your profits so you can be effective, efficient, and productive. And you can get quickly the small problems, the activities that are taking you off course, and make adjustments to pull it back in. That's what this is about. That's how you're going to be running your company. And what you may also want to do is to select key impact areas. Now that you know the indicators, you know the ones that are your strongest, the ones that really pull these numbers, and the ones that need to be adjusted, come up with 6, 8, maybe even 10 key impact areas that you're going to be working on. Get the people together who touch these impact areas, and then work on one key step. Take a 15-minute meeting with that person or the several people on that impact area, like customer service, telemarketing, all these activities that really drive your business, customer relations management, retention practices, deploying marketing materials, marketing drip system. You define what those key elements are in the architecture of your business, and then have a 15 or 10-minute meeting every week to drive forward one creative change to optimize that system until it just becomes cruise control, friction-free, what I call set it and forget it. So if you get your eye on impact areas, you can really drive your business by having your hand on all these different components without getting too drawn into the complexity. You know your numbers, you know the impact areas that really drive them, you know the creative next steps or ideas to optimize those activities, and your confidence is just going through the roof. You're just seeing the yellow brick road to the Emerald City. You're seeing visually how you're going to be able to position this cash flow machine that's going to afford you a great lifestyle. It's going to afford you a great opportunity to retire. It's got leverage written all over it. But you've got to know what you're doing here. So get your hands on this. Okay, so this was the audio on the critical success factors and the scoreboard. Okay, I look forward to talking soon. Remember, implementation is everything. Take one next step with this and take it into your week. Shrink the change and do it incrementally. Focus on what you can do in the next 12 weeks to put this package in motion.